Imagine you have worked whole of your life very, very hard. You have saved some money, but that money doesn't really work for you very well. Today, we are joining by Steve, a seasoned portfolio manager with over 40 years of experience. Steve has developed a unique hands on methodology for generating retirement income. Yes, you have heard right. Not interest, retirement income. Well beyond the typical 4% benchmark, with his own IRA portfolio yielding nearly 12% annually. He's the author of Retirement Money Secrets, where he shares key principles for safely navigating retirement without touching your principal. Steve's approach turns market volatility into an advantage, and we are excited to have him share his insights with us. So, hope you enjoy the show. Steve, welcome to the show.
Ash, pleasure to be with you. How you doing?
Good, good, good. Great stuff. Do you have a favorite quote, something that inspires or motivates you, would like to share with our audience?
A quote?
Yeah,
Yeah, I do, in fact. And it's right on the top of my book. It's the tagline, so to speak. You see money, retirement money secrets, right up there, it says market value fuels the ego, income fuels the yacht.
indeed, indeed. That's pretty correct. I've recently read this somewhere that you know um, getting followers or subscribers on your YouTube fills your attention need, but then making money out of these attention pays your rent. So something along
there,
the same lines,
there
right?
you go. Yeah, getting them to
Great.
listen to you is one thing. Getting them to come and do business with you is another. Yeah, exactly.
Indeed. Indeed, indeed. So let's talk about your story then. How did you started? How did you started your early ages, and then how did you ended up into the financial market? Sorry, financial space where you started helping other entrepreneurs or people.
Well, I started my career um, right out of college, and I was working for part of the financial industry, an insurance company
Hmm.
in New York, and I was commuting from North Jersey into New York, and that's really where I got my start. I had been my well, when I was young, I had, the normal jobs you do when you're a kid, like newspapers, throwing
Yeah,
newspapers on porches. And
yeah.
I did mowing lawns as that was the most thing I did, most lawns. And when I got my driver's license, I started driving a truck in my dad's lumber yard, delivering stuff
Hmm.
to homes
Hmm.
and people all over the place. Um, so I grew up in a situation where if I did work, I kept it. It was my money. I didn't get stressed out for expenses and things like that. And when I went to school, it was all paid for. So I came from a very fortunate environment, and it really culminated when I was 25, and that's when I received this package of securities, literally the certificates that you used to have in those days back in the 70s. It was 1970, and
Hmm.
all these companies that I'm sure you've heard of, like IBM and General Motors and things of that nature, were the type of securities I got. And I was told that it's now my responsibility to take care of these things. So actually, what I wanted to do most was not lose them, not lose any money on it, and
Yeah.
protect, you might say. They all paid dividends, so I got used to the idea of the cash flow from that. And I found a broker who I was fortunate. I found a broker that wasn't there just for herself. She was there to really help, and she taught
Hmm.
me about the markets and how they go up and down, and the volatility, and what difference did it make, and how to look on charts to see where things are in retrospect, in regard to where they've been in the past, and what the trends seem to be. So I did a lot of studying in that, and I kind of figured out from these charts that if you owned Exxon, or in those days it was Esso, if you owned Esso at $30 a share, and you saw
Mm,
that its history, it goes up to 60, then it goes back down to 40, and then it goes up to 70, and back down to 50. If you would just, you know, when it's up, take your profit on it, and then when it went back down again, you'd buy it again, and then do the same thing over and over. And I started doing that. And I
mm,
found other companies. We found other companies that were in a similar vein. They all were good companies, well known, and paid dividends. And I started trading them and trading them.
mm,
Meantime, I was working for this insurance company in New York. And my last job there was in the pension investment department. And I was doing a lot of traveling in that. We were setting up a new type of system, and I would travel, and I get to meet the investment managers who worked for the company's clients and ran these portfolios. And I was asking them questions about why you own this, and why don't you take profits when you have all this profit in
mm,
there, and the answers made me know that the prices of stocks depend a lot on politics as well as market forces, because the answer to the question of why do you own all this Boeing and not take profits is because Boeing was a big insurance client of theirs, and Boeing liked for them to have a lot of their shares in these portfolios that
mm.
they managed. So the light bulb went off. I was afraid I was going to get, you know, reprimanded by the stewardess because it was so bright back there. But the light bulb, so I said, so in every situation from now on, if I have a profit, I'm going to take it, because it's not all economics; it's a lot of politics involved. So
Mm.
that's what gave me that. So that being said, in within the next 5 6 years, I had made enough. I was making more income from my investment activities than I was getting paid by the company. And if I sat home and did the investing, I wouldn't have to pay for all that commuting. I wouldn't have to wear the three-piece suits or anything like that, right?
Mm.
So I decided to get myself registered to be an investment advisor, and I spoke to a couple of my friends to see if they'd let me get started with their portfolios, and they did. And that's in '79. I left the New York job and I started a business,
Wow.
and the business took off because mainly when I looked at people's portfolios, I saw they weren't generating any income, and I showed them my portfolio and how much income I was generating with, the same in the same stock market, just with securities that paid money instead of not paying money.
Mm,
So from 1979, when I left that business, or left my employer in New York, to 2023, when we sold the business, I had grown the business to about 110 million of assets that I was managing for people all over the country, and a couple in Europe as well. So so that at that point, I wrote this book that we talked about, Retirement Money Secrets, and that's actually my third book. But the
oh,
first
interesting.
one, the first one that actually laid out the process for becoming income independent, like I felt I was back then, and how I feel I am now.
Mm.
Um, and I started this business of coaching other people on how to do that. So
Very interesting.
that's the story.
You have gone through all the stages where a normally a person getting into the education system, getting out of it, doing the job in metro cities, understanding the job, in depth, and then potentially trying to get out of the 9 to 5 rat race to become somebody like yourself, like income independent in your words. So Steve, help me out. I treat me as one of your mentee. uh, Treat me as like I have worked with giants around the world. Now I have a little bit of saving. I want to invest into whatever you say, asset, securities, commodities, whichever direction you take me to, and
Hmm.
then want to make money so that when I retire, I have a sufficient amount of money, considering the inflation and living cost at that point of time, so that I can live happily. And then What is the secret of, everybody I speak with about in investing world, they always talk about making profits like in a yearly basis. Then nobody talks about revenue generation every month, right? But you're the first person I came across who's talking about revenue.
Oh yeah, they most people talk about putting your money in this type of a fund or in these securities and just leaving them there and letting the natural forces, economic forces, increase their prices and grow the value of your securities. But as you say, when you look inside, you know, you're getting nickels and dimes, if anything at all, as far as income is concerned from those securities. So what I would tell you to do, what I would have you do is, as I looked at your portfolio with you, I would point out to you that you know this six-figure portfolio that you've amassed here, maybe seven figures, I don't know, um, is paying you less than 2% in income. And although you have some very nice positions here, you have Nvidia and you have Microsoft and you have some of the oil companies and some of the drug companies. You have a nice diverse portfolio. If you had to go out and said, if you wanted to go out and say you had to pay for your daughter's college education or wedding or something like that, and you had to get your hands on 40 grand to pay for this, and that's cheap,
Mm,
really. You'd have to sell something.
indeed. Yeah.
And there may even be a tax implication of selling it, but you'd have to sell something. You wouldn't be prepared income wise. Or let's say you got sick and you couldn't work and you weren't in a job where it was producing, where you had the benefit plan that gave you your full amount, and then you know your tuition payments couldn't be made because you didn't have any enough income to take that and feed. So just having the wealth in the number is not as important as making that wealth produce income, because it doesn't damage the portfolio value to invest in securities that produce income. The value still goes up.
Mm,
Okay, but it goes up as much from reinvesting the income and taking profits on the securities as it does from the growth of the individual securities themselves. Okay. Um, all right. So what I would do is we would talk about that concept, and you would say, "Yeah, I want more income from this portfolio." So then we talk about what you got to sell.
mm,
So we go through. Okay, as much as this company has gone up in value, it's not paying any dividends at all. I know it's a lot of money, so we're going to take 50. You're going to sell half of that, and we're going to take that money and we're going to invest it in a diversified portfolio of closed end funds. And you're going to say, "What is a closed end fund?" Right? That's what you're going to
yeah.
say.
I never heard this word before. Yeah.
What are you talking about? So we'll talk about closed end funds. A closed end fund is a trust. It's a trust established by an investment company like BlackRock or Nuveen or Eaton Vance or Gabelli, and you've heard of those types of companies. It, and it's a pass through trust, which means this trust is designed to make money, and it in order to not pay taxes on that money, it has to pass 95% of what it makes to its shareholders.
Hmm.
Okay, so it has no intention of growing into this huge empire or being worth a gazillion dollars. Its only purpose is to generate income for its owners. So what does this company do? What does this Gabelli, I'll even tell you. I'll go to me. Um, okay, here's one called uh, PIMCO Corporate and Income Strategies. That's the name of this. So what does this thing got in it? It so what this company does, it owns all kinds of bonds of all those nice companies we talked about. that you own there, it owns their debt securities because companies, established companies have equity securities, which a shareholder owns, and it borrows money from banks to build, build buildings, open shops, all the infrastructure that it needs to run its and to pay its salaries. It borrows money, and it borrows that money long term using bonds. So these managers of this PIMCO fund buy up hundreds of these different bonds. And if you went to study economics, you know that when you have bonds, you set them in a ladder so that you have some that mature in 30 years, some in 25, some 20, so on, and different yields depending on all this. So you have that's your portfolio, and you sell, and that portfolio, all that stuff goes into this trust vehicle, and then you go over to the New York Stock Exchange, and you know how they ring the bell sometimes in the
Yeah.
New York Stock
Yeah.
Exchange, but they're just
Yeah.
setting up a new. That's what they do. They take one of these things, and they set up this new portfolio called what I say, PIMCO Corporate and Income Strategies, and they say it's gone public, and we're selling a $2 billion worth of this, and they buy it. Everybody buys it. So now you have this company, and this company has all these bonds that are yielding, let's say, ranging from, depending on how old they are and so on, from 4% to 9% on risk and all that stuff. So then all the income that comes into that, from that, 95% of the net income goes to shareholders.
Hmm.
So you'd figure that, well, the yield is kind of limited to just, whatever you can get those days. But here's the kicker. These guys, just like you would borrow money to buy a car, or your mortgage is a loan, things like that, they'll go out and they'll borrow money short term from a lending institution. And for the last 12 years, they've been borrowing money very cheaply. Now it's more expensive. Then they'll take that money that they borrowed and buy more bonds. So
Mm.
they add, let's say, another 30 or 40% more bonds to that portfolio, generating that much more income, and 95% of that income goes to the shareholders.
Yeah.
So, and then of course, if they're borrowing at 3%, they're going to find bonds that are at 6%. If they're borrowing at 5%, they're going to find bonds that are paying 8%, and so on.
Yeah.
So they
Yeah.
borrow short term and buy long term securities with it.
Got it.
Okay, so that's how they generate more than the normal amount of income. But each month they pay a portion of that income to the shareholders. So there are closed-end fund securities for every possible sector of the stock market or bond market that you can imagine. You can have one that's doing mortgages. You could have one that's in the healthcare industry. You have another in energy. You have another one in AI. Anything you can think of, there's a closed-end fund for it.
Mm.
So what I'm going to get you to do with your portfolio, with your investments in all those different sectors, I'm going to get a closed-end fund in every sector, and we're going to replace your security that's yielding 1% to 3% with a closed-end fund that one I was just talking about is yielding 10.05% right now.
Wow.
Okay. The whole list of 100 of them that I have in front of me, the average yield is 10.55. They've been around an average of over 20 years. They've been in business. And
Wow.
the
Would you be
average
able to share it on the screen? Is that possible?
to share my I can yeah, I can if you want to look at it.
Yeah.
What it does, it shows the names, but they're not recommendations to go out and buy these things. Okay. These are
Yeah.
just facts. These are
Hmm.
just, and it shows the distributions they've made over the over the past year. I'll give you a quick flash.
Sure. Not a
All right.
problem.
Now let me see where my you're gonna how do I use the settings to get to
Just,
share the
just
picture?
click on present, and then you should be able to click on share screen.
Okay, share screen. All right. All right. Let's see. I got to select a tab to share. Let me see if I can bring this window over here. Okay. Window. Ah, there it is right here. Okay. I'm sharing it. Can you
Cool.
see it? There it is.
Yeah,
See, so
I can.
see all these different things, and you see the distributions are in this column,
Mm-hmm.
and I can show the average of them is down here, 10.55, right?
Yeah, yeah.
So this figure here in red in the middle shows they're not it's not negative. What it shows is that was the price in December.
Hmm.
Or it's not the price. That was the amount of distribution. So what this thing is showing is that some of them, the ones with the green, have raised their distributions. Okay.
Yeah, yeah.
The very few of them that have a little red have lowered their distributions. But for the most part, the changes have been green. This one
Hmm.
pays an extra dividend every month. So that's what this is. It's all these things, and you see the different companies and everything.
Yeah, yeah.
But another interesting thing is instead of paying a lot of money for these things, they only cost an average of about $11 a share.
Oh, interesting.
So
And
you can
is
so
this
you can
all
buy it.
security? Is
I'm
this all
sorry.
security market? Everything what you have mentioned. Is it regulated or is it? How does it work?
Sure, it's the same company, the same. It's the bonds and you know other types of income securities like preferred stocks
Mm-hmm.
from all those companies that you trade as equities. This happens to be the income closed-end funds we're looking at here,
Mm.
not the equities. But I can put the equities up there.
Right. So while you're putting the equities, then Steve, the question I would like to go next is,
Here's the
s-
equities. How come it didn't go to them? Oh, it's the same. It's on the same screen.
yeah. So I was just thinking
Yeah.
to ask you is what. So okay, let's take a step back and rewind it a little bit. How much money? Let's say I have a 10,000 pound saved somewhere, $10,000. Um, how much money should I pour into this investment for, let's say, next 10 year to get a $10,000 monthly income back?
With $10,000, you can't get $10,000 back.
You can't, right? So
No.
that's what I'm
It,
asking. How much
what?
money you have to put it in?
Well, if you had $100,000 invested in these securities which have an average yield, I got to get back to the income ones, with an average yield of over 10%, you would get roughly $10,000 in a year
In
from the time you bought that group of securities.
Okay, what about, so let's say, so I have a lot of people who have 10, 20, 30,000 dollars saved.
Right.
How do they how do they how should they plan it? Let's say if they put 10,000 this year and then 10,000 next year and 10,000 next year for the next
Okay. Well,
10 years.
the first thing this listing that I have here has already been quality checked, so to speak. These are ones that I own myself, and that my clients used to own when I had clients.
Mhm.
And when I coach people, this is the tool I give them to select. So they would get a tool like this, or they would go to CEF Connect. That's a website that they can create, look at do their own research with, and they would select these types of securities. And then they would have to diversify their portfolio. They have $10,000, uh, just a starting portfolio. I wouldn't even put as much as $2,000 in any one of them, so
Mm.
that they have a nice diversified portfolio. And then next year, um, next year they add another 10,000 They might add another 4 or 5 different entities until they try have to get in a position where they should have at least 25 different positions in different types of securities and
Hmm.
with different investment companies so that they're
Got it.
diversified portfolio properly. They can
Got it.
learn all about diversification in the book, by the way. Okay,
Mhm.
so but yeah, they start slow. They they put 2,000 or so each in 5 different securities. Some of them preferred stocks, some of them corporate bonds. Nothing that says high yield or high risk or anything like that, because they're just getting started.
Mm.
Until they get another zero on that portfolio, they should be as conservative as possible.
Sure, sure.
And they should never, and once they get to 6 figures, they should make sure they don't have as much as 5% invested in one security. Okay.
Mm. Got it, got it. So, so very high level then, what I understood is if I put $100,000 today
Yeah.
into these securities, then after 10 years, I might be able to get somewhere around $10,000 a month as a return.
No, and right at the first year, you'll be able, oh, not 10,000 a month. No, you'd be getting 10,000 a year. And then, yeah, once you get up to, the $1 million mark, you'll
Yeah,
be
yeah.
making $100,000 a year with these things.
That's what I was thinking because when I speak with these investment bankers and everyone, they all say that you have to put at least 1.2, 1.3 million into their investment bonds to get like $10,000
Yeah, and
return
that
every month.
and
Yeah.
I and they're thinking more of the growth in the market value, not in the income. They're not saying income.
Mm.
They're not saying the
Indeed.
word income. They're saying the word growth.
Growth. Yeah.
Growth and income are two totally different things.
Yeah.
So the income, if you have your money invested at 10% and you don't have to take out anything for taxes or anything for expenses, if it's at 10%, it'll double in 7.5 years,
Mm.
compound with compounding. Okay, so that's how you look at it. So
Cool.
you
And what about the other side of the coin? What are the risks involved in this? So let's say if somebody joins your group. Okay, let's take that question.
well, let's go
Uh
before we do though.
yeah.
You're looking at marketable securities,
Okay.
just like your stocks and your bonds. These are marketable securities and they trade like stocks. And
Mm.
they're sensitive to changes in interest rates. Okay? So even though their regular distribution doesn't change, their prices will change with expectations about interest rates.
Mm.
So let's say we have this environment coming up where interest rates are going to start to go down, the prices of these things will go up.
Yeah.
Okay. So when that happens, you can sell them and take profits and
Mm.
reinvest. So then you have the added income that's created by profit taking.
So
So,
are you saying
so
that whenever mortgage rate of interest goes up, we make money, or whenever mortgage rate interest goes down, we make money?
no, I'm not saying mortgage rate. I'm saying the market rate of interest
Okay.
when it goes down, the prices of these securities go up
Right.
because
Okay.
the yield has to reflect current interest rates. So in that case, you'll have the opportunity to take profits. When interest rates go up, on the other hand, or expected to go up, these prices will go down.
Mm.
But the amount they pay out in distributions rarely, if ever, changes. So
Mm.
you see what happens? The yield goes up when the prices go down. So you can take that income and reinvest it in one of the ones that's gone down, and that will increase your effective yield and decrease your cost. Okay.
Got it. Got it.
So that's the way you use them. Now these things are diversified portfolios, so the possibility that they'll go to zero like a stock would in a bad economic time for that particular industry, it's very unlikely these things own. Like you can see the numbers in this column of of how much they own over here. They own hundred. This one owns 600 different positions, 647, and so on. This one over
Mm.
here is over 900 positions in it. So the likelihood that they're all going to go to zero is like, de minimis. I mean, it just can't.
Yeah.
It's just not going to happen.
Yeah. Yeah.
So
Makes
that's the
sense.
type of thing that you're in. You're in kind of an income production machine.
Mm.
And if you don't have to spend any money, you can reinvest it all at the same price or the same yield. And if they go up in any individual one goes up in price, you can take a profit on it. I took 7 different profits today. One of them was an 8% profit. Eight
Interesting.
percent profit is almost as much as I would get in a whole year of holding it.
Mm.
You know, so
Mm.
we're generating with this methodology. We're creating 2 streams of income, or a regular base income and a capital gains or profit taking income.
Mm.
And
Mm.
this year, so far this year, my my base income, if I divided it by 12 and calculated how much was a month, I've already taken in profits 4 additional months of income.
Wow. That's
Okay, and
amazing.
that's through 7 months of the year. I have
Mm.
another 5 months. I'm guessing that another 1 or 2 months
Mm.
of income will be produced from profit taking. So that's the overall picture of what is created with this. And we
Interesting.
just looked at the income portfolios that I've vetted and that I invest in. There's about the same number of equities with various industries,
Mm.
and there's a third one with tax-free municipal bonds. So if somebody, and that's of course in the United States primarily. I don't know other countries' tax codes. It's
Mm.
funny.
Mm.
I have this coaching client who's from the Netherlands, and she sent me the securities that she had selected for her portfolio. And I noticed that she had selected some of the municipal bonds.
Mm.
These are United States municipal bonds. And although
Mm.
the yields are, 7% or so, I couldn't understand why she had done that. So I wrote her back, why did you do that particularly? So
Yeah.
I'll see what she says. But yeah, so there's a lot of different variables. So
Great, great. So I'm convinced. I want to put my money forward. I want to get the education. What is the process? How do I contact you? Is there an app or is there a platform which you give access to your mentees? Do they
okay.
just put the money with credit card, or do you have to transfer it from the bank account? How does it all work?
Well, I don't know what brokerage firms that you can deal with. You can go if online. You can deal about anybody, can't you? Can you use Fidelity or Charles Schwab and from
We we
anywhere?
we we use trading 212 here. I don't
Okay.
know which one
I
you
haven't
use.
heard of that, but you'll
Yeah.
have to see if they allow you to use if CEFs are something they have on their platform. Um,
Mm.
but what I do is I sit down with the person and look at their portfolio, and normally we'll have that first discussion like you and I, well, like we just had. This is what you got to do. This is where you're going, and then we'll probably have at least one more meeting where he's gotten his feet wet. He's gotten in there. The person has, and he'll say, "I want you to look and see what I've done and comment on it." And we have another meeting like that.
Mm.
And then he's either going to do one or two things. He's going to decide, all right, I understand this. I can do this. I can contact you if I have some easy question, or we can get together. But I'm going to do it myself. Or he's going to say, it's interesting, but it's too time consuming for me to do by myself. I got to still have that job that's making the money that I'm putting in here. So, who can I talk to about this to do it for me? All right. I do have a person that I recommend to people, and or they can try to convince their financial person to do it this way, to tell them, I want you to use this kind of security, and I want you to develop a diversified portfolio that throws off in today's market around 10%, and I'll pay you to manage that type of an investment security. And you might have trouble finding somebody that'll do it.
Hmm. Hmm. And how much typically this person you recommend charges for managing this portfolio?
Well, usually the portfolios are over six figures,
Mm-hmm.
and for the six-figure type portfolios, you'll find 1.5% is what this guy charges.
Hmm. Okay.
It may or may not be the same for,
Yeah,
someone.
and what about the portfolio is not six figure, less than that? How do we do that then?
Well, it's one still it's going to be 1.5%
Hmm.
probably, and it may not be worth it for a very small portfolio. It'd be easier just to have that coaching meeting with me, set up the portfolio, and then do it yourself. Like
Hmm.
even if you just have to leave it there and just once a month find something to invest the income in, because it's going to throw off income, but not a
Hmm.
huge amount. So just
Yeah.
letting it go, if and look at it over the weekend, and if you see you have to take a profit, you're on one of these platforms. All you have to do is go to the platform. You can take a profit.
Hmm.
You know how to make transactions. You learn how to buy and sell.
What,
So
what what are these platforms where you can do it?
the platforms? Oh, okay. Fidelity, Schwab are the main ones. Most brokerage firms of any kind that you have your money with uh,
Hmm.
will allow you to do that.
We
Uh,
we have Vanguard here. Vanguard. Have you heard?
Vanguard,
Yeah.
Vanguard. I've seen a few Vanguard statements. I'm not particularly happy with the information they give you on the Vanguard statements because they're very into selling their own mutual fund products.
Yeah.
Um, I think you can use closed-end funds in a Vanguard program. I don't know if you're doing it yourself. There's no cost. They all have management programs that charge you about that 1.5, I think, that you can
Hmm.
use. So
Hmm.
you have a choice.
So let's say somebody heard this podcast and they want to learn more about it. They want to get in touch with you. What is the process? And do you have some kind of like a percentage based fee, or do you charge like in one go for the coaching?
I do it as one, for each coaching time is about an hour 15 minutes, somewhere in that range, and I have a flat fee for that. And then if we need another coaching session, we will. If we just need to review a portfolio after that, that's a different cost. Or if he just
Mm.
wants to get together for questions and answers, Q&A
Mm.
type thing, we can do that. It's very flexible. It's very
Got it.
flexible. And I have some arrangements where people who are retired, probably most of them, and have very large portfolios where they hire me for a year, and I meet with them once a month just to help them get this all set up. And these are wealthy people that have large portfolios, and they have to
Indeed.
maybe five or six different portfolios or other types of properties to start moving into the income direction.
Mm.
So it varies.
So can you share a compelling case study that highlights how somebody has used your services and got amazing returns? I mean, it doesn't has to be big,
I
seven
well,
eight figures case study.
I don't have a case study that I can. I've done so many different individual scenarios with people over the years where, I've created literally dozens of millionaires over the
Mm.
years managing their portfolios and paying them income at the same
Mm.
time, reducing their portfolios. Yeah. Uh, I don't have access to those portfolios anymore, but you could certainly contact the people, I guess. But with my coaching clients and just getting into, you can just go into my Facebook group, you know,
Hmm.
so let's say somebody reads the book and they want to see how other people's done. There's a link to my Facebook group of almost 2,000. No, I think it's 1.2, 1.3 thousand people right now who have kind of have read the book and are implementing the process. I mean, almost every day you'll have somebody telling a story about how well they've done with the program. Just
Awesome. Would you be able to show our viewers your book? Can we see it
yeah,
on the camera?
yeah. Here's the book.
Awesome.
There it is, right there.
Retirement Money
Se-
Story by Steve Silligan.
Secrets, retirement money secrets. This is one of the ones they give you that they give you a couple free copies when you get it published, and
Yeah, yeah,
not
yeah.
for resale, so they had that blocked out. But it's secrets. There's no on the actual book. There's no bar there, so
Mm, mm,
I could show you actual. So it's retirement money secrets, and it has all the information we talked about and contact information and stuff like that. This is the first interview I've had with somebody that has did a case study as a way of talking about it. I really have enjoyed this. That's really
Oh
cool.
yeah, yeah, yeah. I always love to talk about, because you see, I think I fit into your ICP, ideal customer persona. I'm the person who has been working for 15, 20 years in the industry. I'm the person who saved a little bit, but I'm still looking for somewhere to invest and get, things rolling so that I can be ready for my retirement. Um, but I don't want to get into the technicalities into this.
You
So,
don't want to. Yeah.
yeah, when you said that you have a person, I got really interested in it, but then you mentioned that the person only manages six figures. That's where it was discouraging for me. But the good thing is, it is good to know that once I reach to six figures, at least I can come to you and then you can refer me to that person, right?
Right. Right. Or
Yeah,
you never know. He might, you know, for a podcast person, an influencer like yourself, he may want to get on your show and talk about this type of investing too. So you guys can make a deal. I don't know.
oh,
That's
that would be great.
that's
Yeah,
between you and him. But I'll tell him if when you and I can, connect with some emails after we have this conversation. Who knows?
definitely, definitely. That's great. And just before we get into our lightning round, Steve, I want to understand, you had so long experience in this space. What are the biggest mistake people do while they're looking into these securities and investing into that?
I, in any form of security, the
Hmm.
biggest mistakes are always not really determining the quality, um, focusing on market value only instead of on the income that can be produced, because
Hmm.
income production is part of quality when you come right down to it. If a company or an entity can afford to pay you some money, they have to make money in order to do that.
Hmm.
Okay. Diversifying properly, that's another one. You find people who find a stock and it does really, really well for them, and they just refuse to sell it, and it grows and it grows and it grows, but it's not really doing them any good until they capitalize on it. And then, of course, then they have the tax consequences. So those are the big three. But the biggest mistake is not taking profits, because
Hmm.
inevitably they'll be so in love with these things right about the time the market crashes. Just think about people who had just gotten started in NVIDIA and had ridden it up and ridden it up, and ridden it up, and didn't even think of taking a profit. And we had last week happened
Hmm.
where the NASDAQ lost almost 20% of its value,
Yeah.
or not really. Yeah, I think something like that. At least 17%, I think. So,
Hmm.
you know, and then they lost it. And then they probably, oh God, I can't do this. I'm going to just sell it and get out of here. So that profit, they never had that. They never took that profit.
The profit. Yeah.
So those are the big four. A fifth one would be not understanding that there is a market cycle, that the
Hmm.
economy is cyclical, and it can be in a different cycle, different places of the world, different industries, different types of securities. There's
Hmm.
a flow of up and down in everything. The
Hmm.
trend is typically up, and you can determine where in the trend you are. The problem is you can't determine what's going to happen next.
Hmm.
So,
That's
no,
true.
but knowing where you are in the stock market, if I know I'm near a high of the stock market and I'm going to buy a stock or a stock closed end fund, I'm going to buy less of it than I
Mm,
would if I knew we were at the bottom of a cycle. Then I'd be safely buy more because it's more likely to go up. When it's up, it's more likely to go down.
mm,
Interest rates are the same way. If people are expecting interest rates to go down, the prices of the securities are going up. If they're expecting interest rates to go up, the prices are going down. So
mm.
if you know interest rates are going to go up, you buy less of the security that's an income security and so on.
Yeah, yeah.
So
So
knowing that cycle exists is very, very important. It's not up only. No matter what you bought or who recommended or what anybody tells you, everything can go down.
yeah, yeah. So just to reiterate, quality, diversity, taking profit, and cycle,
And income generation.
income generation. Yeah, five of them. Perfect. That was eye opening for me, Steve. Trust me, that was really really good.
Okay.
Great. I would love to do another episode with you, which is will be continuing with this one, because there's so much information to process for somebody like us who's like new in this space and all. But we can talk about it later. So let's jump into our lightning round. Are you
Oh,
ready?
I think so.
Great. So what are the three top strategies in 2024 to select your portfolio into?
Um, it's it's not a. I will do the same thing that I do now in 2024 as I have every other year of my investment existence. I will have a target profit that I will take on
Hmm.
any security I own when and if I can. I will have the same quality and diversification and income parameters that we set.
Hmm.
Um, I will not try to predict or time or think I know what's going to happen. I'm going to look at where we are in the market cycle and make my decisions as to how much I invest based on where I think we are in the cycle at that particular time. So uh, I don't have a prediction for, and
Got it.
I particularly don't have a prediction this year because we're in the middle of a presidential
Yeah,
election
yeah,
season. So
yeah, yeah. Who knows what's going to happen
who
after now?
knows? But but thinking about it the way I do and the way I operate, I don't care which way the market goes
Mm,
or
mm.
interest rates. I'm going to take advantage of it one way or the other.
One way or the other. Yeah, that's great. That's great. Question two: what book would you recommend to our audience and why?
I'm going to fool you. In addition to my book, I would think everybody should take a basic business or basic economics or business type book so they
Mm,
get an idea what's a stock. Most people have 401ks or some other type of pension plan or profit sharing plan that they have, and they really don't know what's inside. When they put their money in that thing, they don't know that they're in the stock market, but they are. And they're if they say income on the where it says income and they check off that box, well then they're in the bond market. They need to know what they're buying. They
yeah,
need to know what the risks are associated. They need to know that owning a stock means you own that company. And if that company goes bust, you have hundreds of people who have 401ks
mm.
and they're out there in the streets protesting about big business making too much money. They don't know that they own those companies.
A little bit, a little
You know
bit
what I
of
mean?
them.
They own a little bit of it, but it makes a
Yeah,
difference to
yeah,
their survival. Okay.
yeah, yeah, yeah.
So, yeah,
Great.
okay.
What one attribute or characteristic in your mind of a successful investor?
Successful investor has patience and discipline.
Hmm.
He
Very
sets he
interesting.
sets his guidelines and rules and he follows them. And
Hmm.
he has the patience to wait for the things to get where he wants them to be.
Right, right. What's your favorite personal productivity tool or habit?
There are people like me who get up early and start working and would keep right on working if somebody didn't grab them by the ear and say, "Okay, come on, it's time for dinner." You know, so I think you've got to be willing to put in the time to learn, particularly learn from your mistakes.
Hmm.
But you've got to have particularly in the investment business, you have to develop a routine that you follow. Like, for example, I place my orders at the end of the day. After the market closes, I determine what I'm going to buy the next day.
Hmm.
And I won't change that on the buy side. I won't ever buy anything that I didn't plan to buy the day before. On the sell side, I'll look see if there's something else that just went up that I
Hmm.
should look at in addition to the ones that I put there. But
Got it.
yeah, you gotta form a way, an approach, a routine, and stick
Hmm.
with it.
Yeah. Yeah. Okay. And last but not least, what's one of the most important passion of yours outside your work?
Other than my wife,
Yes,
um,
please.
I would say right now, it used to, 5 years or 6 years ago, I would have maybe said that had golf in there as one of them. But
Hmm.
now it's travel.
Hmm.
It's travel. I mean, I want to get almost every place in the world I haven't been. You know,
That's awesome.
where
That's
I can
awesome.
go safely
Yeah. 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 Definitely. Definitely.
while I'm still young.
Yeah. Indeed. Indeed.
Yeah.
Great, Steve. Thank you so much for joining me and sharing your story. Unpacking your last 40 years of building this whole
Well,
coaching business and some of the ups and downs. If people want to check out or they want to contact you, what's the best way to do it?
the book is number one, Retirement Money Secrets, at Amazon and any place else. And second one is the website, I guess,
Mhm.
um, theincomecoach.net, and of course the Facebook group. I think if you just Googled my name and Facebook group, is probably you'd probably
If
find.
you, yeah, if you just give me the links for your book, your website, and your Facebook, I'll put it in the episode in the bottom.
Okay. Okay.
Yeah.
Okay.
Great, Steve. Thank you so much for joining us today and sharing your inspiring journey and the impactful work you're doing with your coaching. It's been an absolute pleasure having you on our
Well,
Founders
for
podcast.
me too. Your approach to this was unique. It's the first one that I did like this, and it was really very enjoyable. Thank you.
Great. Thank you all for tuning into this episode of Founders Podcast. I hope you found our conversation with Steve insightful and inspiring. Make sure start investing into your retirement income right now. Okay. If you enjoyed this episode, make sure to subscribe to our podcast and stay updated on future interviews with proven founders and industry experts. We have a lineup of incredible guests and valuable insights coming your way. Stay inspired, stay motivated, and keep building.